Welcome back, accounting boffins, right? Remember, we're busy with cost accounting, and we said, quick overview, our cost accounting tells us we have our stock accounts, where we move into our cost accounts, and then we move into work in process. Remember, the three most important categories of your work in process would be your materials, your labor, and obviously your factory overheads, and this would then give you your production cost. Okay, right, the activity that I promised you, here we go. Let's take the item and place it within the correct column where it needs to be. For example, indirect materials. Based on the activity that we've done, we know that that is a factory overhead, right? Advertising, clearly you know that that has to do with selling, so obviously it would be a selling and a distribution expense. Next one, direct labor. Now remember, there are two prime costs. In the manufacturing of any item, there are two prime costs. What are your prime costs? It's direct material plus direct labor. So therefore, your direct labor would be a prime cost. Okay? The next one, remember I said, look at the expense, but see what comes before it. Factory rent. That means that would be a factory overhead, right? The next expense says office stationery. So where was the stationery used? It was used in the office, therefore that would be an admin cost. Okay, so you must be able to place the cost in its relative component, and this will make it much easier for you to understand when you're doing the actual ledger accounts and related information. Okay, so now we move on to our question. It says here, Julius Mamba manufactures handbags. He works at home using his father's garage. He's only able to produce 40 handbags per month. Okay, that's our information. We are expected to calculate the total fixed cost, the total variable cost, right? The selling price at the break-even point. Okay, and then obviously, will Julius be satisfied with the selling price? So, before we actually go into the question, let's first make sure we understand what we mean by fixed costs and variable costs. Right, firstly, fixed costs are all those costs that remain constant irrespective of the number of units that are produced. Right? Now, if you take your 5 cost components, break them up into the 2 categories, right? So we have fixed costs would be your factory overheads plus your admin costs. Think about it. The people that are working in the admin section, immaterial of how many units you produce, you still have to pay the secretary the wages at the end of the month. So those 2 costs, namely your factory overheads and your admin costs, would fall within the category of your fixed cost. Right. Then the other 3 cost accounts, what are they? It's direct labor plus direct materials, okay, and your selling and distribution costs. Those 3 costs will vary with the levels of production. In other words, the more you produce, the more labor you need. The more you produce, the more materials you need. The less you produce, the less selling and distribution expenses there will be. So clearly you can see that these 3 cost accounts would fall within the category of variable costs. Once again, fixed costs do not change with the number of units that are being produced. Or in other words, variable costs vary with the number of units that are being produced. Clear? Okay, so now we have understood the concept of fixed cost and variable cost. Okay, so the question now says, these are the average monthly expenses, material and other components, direct labor, rent for the use of the garage, water and electricity, which 60% is your variable, indirect materials used, sundry expenses in the manufacturing process. So these are just your information on which the question will be based. Okay, now we are asked to work out the total fixed cost. So this is what we do. Firstly, let's identify our fixed cost. Okay? So immediately you go in and say, fine, we're looking at fixed cost, which would mean it would be my water and electricity, right? 775, however, they're telling you 60% of it is your variable. So immediately you go here and you say 775 times the 40%. So obviously, let's do that calculation. We've got 775 times the 40% will give me a figure of 310. So that's my 310 there, right? So going back, let's find the next item that we need. Remember, we're working with fixed costs, okay? So you have to look for the information to determine what are your fixed costs. Okay, so the next item we find there is our 1,250. Clearly you can see your rent, because it falls within the ambit of your factory overheads. Obviously, that would be your fixed cost. So clearly, the rent of 1,250 is the next component. So that's your rent. Okay. This one was your water and electricity. Right. The next item that we look for is to see what else are we told. We are told indirect materials used in the manufacturing process works out to 460. Let's see, there's my 460 there, right? And then I can see the next item that I need there will be my sundry expenses in the manufacturing process, which will be my 200. Let's go back. Here we go. There we are. So all these components would be, remember this 310 is obviously the calculation of that bracket. So if you add 1,250 plus the 310 plus the 460 plus your 200, you will get a figure of 2,220. So your total fixed cost, can you see in this particular question, you had to identify your fixed costs. Remembering that fixed cost has two components. What are they? It's your factory overheads and your admin cost. Okay. Now that we have our total fixed cost, the next item we need to calculate is our total variable cost. Okay, once again, looking at our information, we know that a variable cost would be direct material, direct labor, and my selling and distribution cost. Okay, so here we go. Look at your direct labor. You can clearly see here that you got the 555, which is your labor, okay? And you also have your, so there's the 555, we bring it in. The next item that we look at is materials for the components was 520. So again, you bring in the materials at 520. Let's do that. There's the materials. So let's just label it, making our task a bit easier. Our material was 520, so therefore 520 would be material. The 555 was your labor. There we go. Your labor was 555, so that's your labor, right? And then you were also told that, and this is important, you were also told that in your water and electricity, 60% was the variable component. Okay, so obviously in this activity here, notice that the examiner wants to see whether you can separate your fixed and your variable. So your variable, if that was 60%, obviously it would be your 775 times your 60%. Okay, let's do that. It would be 775 times 60%, and this will give me a figure of 465, right? So here we go, that would be 465. Okay, so if you now add 520 plus 555 plus your 465, it's going to give you a total variable cost of 1,540. Okay, so you can clearly see you must be able to identify the items in order to be able to calculate your fixed cost and your variable cost. Now we come to the very important concept of break even, right? What do we mean when we say break even? Watch. It is the number of units that must be produced and sold to cover the total cost, where obviously your incomes will be equal to your expenses. In other words, you're not making a profit or a loss. So the total number of units that you have to produce and sell in order to break even. So at the break even point, your incomes are equal to your expenses, right? They are equal. That means no profit is being made and no loss is being made. But the moment you produce more than the break even point, obviously you're now making a profit. And if you produce less than the break even point, obviously you're then going to make a loss. So the break even point is a very, very important indicator for a manufacturing concern. It gives them a clear indication of the number of units that have to be produced in order to break even. And this is the point where they will neither be making a profit or loss on the process if at the break even point. So if the break even point is, for example, 5,000 units, at the point of production of 5,000 units, the business will neither be making a profit or a loss. Okay. Then it shows you the level of sales that is required. It assists with determining the markup, percentages, and in assessing whether the production of this product is a viable venture or not. Obviously, this will give you a clear indication whether it is viable to continue making the product. And that will then inform you as to what your markups have to be, what your percentage, you know, when you do those other financial indicators, when you're working out your percentage markups, you would see it would tie in with this here. So we have the information again of Julius Mamba, and the question said now, the selling price at the break-even point. Okay, what have we done so far? We've calculated the total fixed cost to be 2,220. We've calculated our variable cost for the 40 bags to be 1,540. Okay, what are we going to do now? The question says, what will be the selling price at the break-even point? Notice a twist or a challenge in this question. You normally ask to calculate the break-even point. What is the calculation for the break-even point? It is your total fixed cost in rands over your contribution per unit. What is your contribution per unit? Selling price per unit minus your variable cost per unit. Please, guys, it is important, it is imperative. You have to know this indicator before you attempt to actually answer it, right? So what is it once again? It is your total fixed cost in rands divided by your contribution per unit. And what is your contribution per unit? Selling price per unit minus your variable cost per unit. Okay, this means therefore, there we go. Our variable cost per unit would be the 1,540 divided by the number of units, which is your 38 Rand and 50 cents. So there's my total fixed cost, 2,220, over selling price per unit minus your variable cost per unit. Remember? And we also know that the total number of units that we have produced is 40. So there we go. You take the 2,220 plus the 1,540 divided by the number of 40, which obviously is your number of units that you produced, and it gave you a figure of 94 Rand, being your selling price per unit. Okay, so this is how you calculated your selling price per unit. So in the entire calculation, your selling price per unit was your unknown. Clear? And because you were then solving for X, which was your unknown, you came up to a figure of 94 Rand. So, will Julius be satisfied with the selling price? The answer obviously is no. He will not be satisfied with 94 Rand per bag because he will not be making a profit. He'll only cover his costs. So understand this, that at the break-even point, you're not making a profit, neither are you making a loss. Would you be satisfied with that? Certainly not. Right? He must assess the market and competitors to determine if he would be able to sell these bags at a higher price in order to show some profit. So if he continues to sell at 94 Rand, all that he's doing is he's breaking even, meaning no profit, no loss. So all the efforts for nothing? Definitely not. So he needs to assess to increase that selling price so that definitely we could then be making a profit. Okay guys, that's the end of this segment. Let's take a quick break, let's refresh, and when you come back, we start with the last segment for today's show. See you just now.